defer the taxes, you'll thank yourself later. This is one of the most common pieces of tax advice given to high-income Californians. And often, it can be good advice. But there is a quiet assumption behind this advice, that the tax you defer today will not come back in a more expensive way in the future. The terms tax saving and tax deferral are often used interchangeably, but they do not mean the same thing. And confusing these two terms could often lead to poor financial decisions. Some tax strategies permanently reduce taxes. Others simply move your tax bill into the future. And some tax deferral strategies may also change how your investment gains are taxed in the future. Your goal should not be limited to reducing this year's tax bill. Your goal should be to understand the full trade-off and then make decisions that build your long-term after-tax wealth. Hello everyone, I'm Aaratee, founder of Aaratee Financial. I worked for more than 20 years at the intersection of finance and technology, including leadership roles at major tech companies and leading financial institutions. On this channel, I break down practical tax, investing, and wealth management topics for high-income Californians. Today, we're breaking down the difference between tax savings and tax deferral and why that distinction matters. We will cover 5 common strategies in each bucket, starting with tax savings. We'll then talk about tax deferral strategies, including retirement account trade-offs. Finally, we'll cover a simple framework for evaluating any tax strategy. The key idea is that most tax strategies have trade-offs, and lowering your taxes today does not always mean increasing your long-term after-tax wealth. Tax strategies usually fall into 2 broad buckets. The first bucket is tax savings. This is when your tax is permanently reduced or eliminated. The tax is not owed now and it is not owed later. The dollar saved is truly saved. The second bucket is tax deferral. This is when you shift the tax from this year to a later year. You're not eliminating the tax, you're moving it to a future date. So if you save $1 today through a deferral strategy, you may owe that dollar back later. How much you owe in the future depends on your tax rate at that time. And sometimes deferring taxes can also change how your investment gains are taxed in the future. So the analysis is not just about today versus tomorrow. It is about timing, tax rate, tax character, liquidity, and flexibility. If you remain in a high tax bracket due to large retirement balances, business income, rental income, passive investment income, or future RMDs, the benefit of tax deferral may be less obvious. The point is not that tax deferral is bad. The point is the benefit of deferral strategies should be evaluated against trade-offs, not assumed. Let's look at few tax saving strategies. These are 5 examples where your tax obligation is permanently reduced or eliminated and not just deferred. The first example is a health savings account or HSA. An HSA can offer triple tax benefit. You may get a deduction going in, money grows tax-free, and qualified withdrawals for medical expenses can come out tax-free. The second example is direct US Treasury securities. Treasury interest is taxed at the federal level, but it is generally exempt from state income tax. For California residents, that tax saving can be meaningful. The tax is not deferred here, it is not owed. The third example is a 529 plan. Money in a 529 plan can grow tax-free, and qualified withdrawals for education purposes can also be tax-free. The fourth example is qualified small business stock or QSBS. For founders, early employees, or investors in qualifying companies, QSBS can exclude a significant amount of capital gain from the federal tax if the requirements are met. The fifth example is step up in cost basis at death. When appreciated assets are inherited after death, the cost basis may reset to fair market value. For high net worth households, this is one of the most powerful tax planning concepts available. Years of appreciation in a stock portfolio, real estate, or business interest may be removed from the income tax base when a step-up applies. This is why estate planning, tax planning, and investment planning should not be treated as separate conversations. Let's look at a few tax deferral strategies. Unlike tax saving strategies, these are 5 examples where you shift the tax from this year to a later year. With these strategies, you are usually delaying the tax, not permanently eliminating it. The most common example, and one that many people use, is the traditional 401k or traditional IRA. You contribute pre-tax dollars and reduce your taxable income today. The money grows without annual tax drag. But every dollar that comes out later is generally taxed as ordinary income. This includes your initial contribution and the growth. There is no long-term capital gain tax benefit. Second example is non-qualified deferred compensation. Executives and high earners may choose to defer income into a future year, often retirement or another low-income period. This can be a useful tax deferral strategy, and I personally used a deferred compensation plan while I was working at Microsoft. But it is important to understand the risk, including the fact that deferred compensation is generally tied to employers' financial condition. A tax deferral strategy for highly appreciated concentrated stock position is an exchange fund. An exchange fund allows you to contribute that stock into a pooled fund with other investors. In return, you receive an interest in a diversified portfolio. This can be powerful if you're looking for diversification without triggering capital gains tax today. But an exchange fund is not a permanent tax saving strategy. It is primarily tax deferral with other considerations like holding period, liquidity constraints, fees, and the quality of the diversified portfolio you receive. Tax loss harvesting using direct indexing can also be partly a timing strategy. With direct indexing, you own individual stocks that closely track an index. When some positions decline, you may sell those stocks to harvest losses while keeping your overall market exposure similar through replacement stocks. The harvested losses can then offset capital gains or, within limits, ordinary income. But the benefit often includes a deferral component. When you buy replacement stocks, the cost basis may be lower, which may increase your taxable gains later. So with strategies like exchange funds and direct indexing, the benefit is always delaying tax, not eliminating it. The fifth example is real estate depreciation. Depreciation can create a tax deduction today, but it may also create a depreciation recapture when the property is sold by you in the future. The common theme is with tax deferral strategies, you shift the tax bill to the future. You don't eliminate it. Let's talk about some trade-offs with traditional retirement accounts. First, there is no long-term capital gain tax benefit. In a taxable brokerage account, gains from stocks or ETFs held for more than a year may qualify for long-term capital gain tax rate. But in a traditional 401k or IRA, all future withdrawals, including growth, are generally taxed as ordinary income, which may be taxed at higher rates. Second, traditional retirement accounts do not receive the same step-up in cost basis treatment as taxable brokerage accounts. So if you inherit a taxable brokerage account, the appreciated assets may reset to the fair market value. But if you inherit a traditional IRA, you generally inherit a future income tax obligation. Third, there are required minimum distributions or RMDs. Starting around age 73, you're required to withdraw money from your traditional retirement accounts, and those withdrawals are taxable. If the account is large, RMDs can increase your taxable income even if you don't need the cash. Fourth, there are early withdrawal rules. For most traditional 401ks and traditional IRAs, withdrawals before the age of 59 and a half may trigger a 10% early withdrawal penalty on top of the ordinary income tax. The default assumption should be that traditional retirement account money is not as flexible as money in a taxable brokerage account. But again, this does not mean traditional retirement accounts are bad. It means that there are trade-offs that you must consider during tax planning. The bottom line is tax savings and tax deferral are both important. Tax savings can permanently reduce your tax burden, and tax deferral gives you timing flexibility, but they're not interchangeable. The goal is to understand what you're actually getting. Sometimes you're getting permanent tax savings, sometimes you're getting valuable timing flexibility, and sometimes you are accepting future ordinary income treatment, reduced flexibility, withdrawal restrictions, and forced distributions in exchange for a deduction today. That may still be the right trade-off, but it should be a conscious decision, not an assumption. Before implementing any tax strategy, ask these 5 questions. First, is the tax eliminated or just delayed? Second, does this create a future tax liability, and what do I expect my future tax rate to be when this obligation comes due? Third, will the tax character change? Fourth, how does this impact my liquidity and flexibility? Can I access the money if I need it? Are there withdrawal restrictions? And fifth, is there a path to convert tax deferral into permanent tax savings like Roth conversions or charitable deductions? Remember, a tax strategy is only good if it fits the rest of your financial life. If you found this video helpful, please subscribe for more videos on tax efficient investing, cash management, and tax planning for Californians. And if you need help to think through your own cash, tax, and investment strategy, you can learn more at our website, aurifinancial.com. Thank you, and I'll see you in the next video.